What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast. And for everybody listening on any podcasting 2.0 apps such as Fountain and Streaming Me Sats, it is greatly, greatly appreciated. Thank you so much for supporting the show. And if you're listening on anywhere else where you get audio podcasts, be sure to hit that subscribe button so you get the next episodes directly to your feed. Or if you're watching on YouTube, you get to see my beautiful face. Hit that like button and also subscribe to my channel. I've been trying to get that to grow, and all the support is greatly appreciated. And it helps me bring in, a lot of great guests. And speaking of great guests, I have one in the waiting room here. I got Doomberg, probably the most famous green chicken on the internet. So Doomberg, how you doing today?
Brandon, I'm doing great. Thanks for having me on.
Yeah, so I mean, for those who don't know you, one, like I don't know what you're doing on Twitter. You gotta follow his account and check out his Substack, as they put in great research. But why don't you give us a little bit of your background and kind of where you cover?
Sure. Yeah. I'm a Doomberg head writer for the Doomberg Substack, as you mentioned, which is our primary livelihood these days, our primary business. It's a Substack we started 2 years ago. We're a small team of previously we were running a consulting firm. We still have some business in that regard, but we come from the commodity sector predominantly. The Doomberg Substack covers energy, finance, and the economy at large. We like to say that we explain complex technical issues to financial professionals in a language that they can understand. We publish, 6 to 8 times a month. Just put out a piece this morning, so you caught me at a good time. Publication day is always nice because I get that one day to breathe before we decide what we're going to write about next. And so, yeah, it's really been a remarkable run. We started this 2 years ago. We're the #1 finance Substack in the world, almost 250,000 followers on Twitter. It's been a real whirlwind. And so, yeah, it's just truly amazing what can happen in the content creator space in 2023. Like anybody could start a Substack, anybody could start a podcast, and really it just comes down to your disciplined execution. How much effort you put into it will dictate how much of a reward you get out on the back end.
Yeah, for sure. And that's definitely an understatement. But I think, what one thing that's unique about your Substack and everything that you guys cover is I feel like you have like a very in-depth, like broad range of just overall macro topics, which I absolutely love. But you mentioned the energy sector, and there was just an OPEC meeting and kind of some, I guess, hubbub around that and the oil and gas industry. So, why don't you, I guess, set the stage for us as to what happened in this OPEC meeting and, give us your take on it.
Yeah, actually, it wasn't a meeting, which makes it all the more surprising. On Sunday, OPEC Plus, so if you take the OPEC nations and include Russia, announced effectively a 1.6 million, 1.65 million barrels a day surprise production cut. This comes as a surprise, I would think, to the Biden administration, and it's certainly upsetting to them. It is a substantial cut, one that the market didn't anticipate, and as we're talking, oil, WTI is sniffing $82 a barrel from the low 70s last week. And so from the perspective of the OPEC Plus nations, the surprise cut had its intended effect, which is to shore up the price of oil. In our view, this is really a critical juncture in one of the world's most important relationships, which is that between the United States and Saudi Arabia, which for decades had been really a centerpiece focus of U.S. foreign affairs. And by all measures, at least from outside observers, that relationship is probably at its weakest state that it's been in 50 years. And lots of good reporting in the Wall Street Journal and the Financial Times in the past few days about how effectively this was a response to the Kingdom of Saudi Arabia's anger with President Biden for refusing to refill the Strategic Petroleum Reserve, as he apparently promised he would do to support oil prices in this range. And this looks like a bit of a petty tit for tat. And let's hope it doesn't continue to spiral. But it is, I think, the personal animosity between MBS and Joe Biden is something to keep a very close eye on. And when it comes to political leaders, I wouldn't underestimate the impact of egos, even superseding national interest.
Yeah, no, I hear that 100%. People in power definitely really want to stay in power and kind of keep that control. But I also did see like a tweet. I don't know if it was like a report from the terminal or who it was released by, but I saw a tweet that said the U.S. that got a heads up on the OPEC plus production cut plan. It was reported by Kirby, I believe. So I in your perspective, one, do you kind of buy this report, because it feels like it's kind of like you said, like almost all of the sudden released on a Sunday, not generally a big news day, kind of more of a relaxing day, and yeah, from there it seems like they're kind of there is this tension between the U.S. and the OPEC countries. So do you like kind of buy this report, and like two, like what would be the benefit of the U.S. like releasing this information that's saying that they got this price cut or production cut information ahead of time?
Well, I would say two things: that report is almost certainly true and basically meaningless. If the relationship between the United States and Saudi Arabia has dissolved to the point where a mere sharing of a factual set of actions about to transpire is the sum total of the negotiations ongoing between the two sides, then that sort of proves my point in my first answer, which is things are at near rock bottom. I mean, for decades, again, there was basically a deal between the United States and Saudi Arabia, which was the U.S. would provide defense and protection to the kingdom, and the kingdom would ensure a steady flow of oil at a reasonable price. And then in return, the U.S. would maintain U.S. dollar strength to the point where the sellers of that oil could save, recycle their excess profits into U.S. treasuries and keep massive amounts of U.S. dollar reserves, knowing that their money would be good. And so really starting when the global financial crisis, when Ben Bernanke made clear to the world that the U.S. dollar was no longer as good as gold for oil, we're seeing these changing geopolitical trends. And it makes for a fascinating analysis on Twitter. It's not really our depth of expertise. It's something we observe and we have some experience in, but watching people try to either explain this away as nothing or make it into something much bigger than it is sort of classic what Twitter does, of course. But in our view, it's important, it's notable. Informing, that could have been 5 minutes before the announcement. I mean, technically they were given a heads up. Okay, I mean, big deal. It's not like the U.S. said, please don't cut, and they listened. So in our view, this is the latest in a series of steps that ultimately we believe is going to lead to some form of a confrontation between the U.S. and Saudi Arabia. It's the topic of a piece we're researching now, and who knows how that's going to go. The history of Middle Eastern leaders confronting the U.S. dollar hegemony with respect to oil is not a glorious one for Middle Eastern leaders. We'll see if either cold or hot conflict spontaneously appears now. It's something that's certainly worth keeping a very close eye on in our view.
Yeah, and it also seems like at the end of last year, maybe like November-ish time, there was a bunch of screams on Twitter for somewhat of an energy crisis, but the U.S. has kind of continually deployed those the oil reserves, and it seemingly like essentially depleted those reserves in a sense to try to keep the gas prices down, kind of try to ease some of that energy concerns. But it seems like these with this lack of production, maybe kind of almost seeming like kind of cutting out the U.S. in a sense, kind of like you're describing, like maybe some political tensions rising, with the mix of Russia in there and everything like that. Do you kind of still foresee maybe potentially somewhat of an energy crisis? Like how drastic is the I guess the energy situation in the United States and globally, just because of this situation going on, cutting production, and yeah, like I mentioned previously, depleting the reserves.
So just to give your viewers and listeners a framework to put these numbers into some focus, as the war in Ukraine broke out last year, President Biden, seeing oil above $100 a barrel and recognizing the peril that that represented to his party's reelection chances in the midterms, decided to take the Strategic Petroleum Reserve bazooka and fire it. And over a 180-day period, he was releasing oil from that reserve to the tune of 1 million barrels a day. The cut that was just announced by OPEC is 1.6 million barrels a day, which gives you some indication as to the seriousness of the surprise. Here we are, sort of with even more, mandated sales from the SPR teed up and accelerated into April ahead of the driving season. We're at a point where the SPR hasn't been this low in 40 or 50 years. I forget the exact number. It's less, I think, it's less than half capacity. And by the way, there's all kinds of saber rattling between the U.S. and China right now. So the point of the Strategic Petroleum Reserve is to be a strategic reserve of petroleum and not a tactical political tool to micromanage the price of gasoline in an election year. And so what we believe has happened is when Biden flew to Saudi Arabia, he promised that if oil prices got into this range, around $70 a barrel, that he would begin the process of refilling the Strategic Petroleum Reserves and thereby putting a floor under prices. And last week, Energy Secretary Jennifer Granholm, who my guess has never visited an oil refinery or a production facility in her life before becoming Energy Secretary, said almost flippantly that it would be several years before they would even begin thinking about refilling the Strategic Petroleum Reserve, which to the Saudis' ear sounded like a reneging on their promise. And so thus the surprise cut came. This is all within the backdrop of what Zoltan Posner correctly calls sort of commodity encumbrance, where everyone talks about the oil market being 100 million barrels a day, but in reality, what is the free float of tradable oil? A lot of oil is produced where consumed where it is produced. Now, to your specific question, the U.S. is fine energetically. We have the cheapest natural gas prices in the world. We're the largest producer of oil in the world. By and large, there's a whole pantheon of countries that will suffer far quicker and far more greatly than the U.S. In fact, NATO, if you drew a circle around Canada, NAFTA, if you drew a circle around Canada, U.S. and Mexico, we are basically fully self-sufficient across all important commodities, a true energy and food superpower. The U.S. will be fine. But politically, Biden understands that what an energy crisis in the U.S. is $5 a gallon gasoline. Vast majority of the world is paying way more than that already, even at these prices. And so it's all a matter of perspective and degree. But in reality, the real risk to us is a sort of further deterioration of the relationship between Saudi Arabia and the U.S. to the point where things spiral out of control.
Yeah, and I mean, I guess that all makes sense, but where I get, I guess, confused in all of this, and maybe you could shed some light, or maybe agree with me on it, or whatnot. But it seems like there's always been a push, especially for the current party in power, for more of the green energy to kind of get away from oil and natural gas and these kind of energy sources, but with the amount of, I guess, exported oil kind of depleting and seemingly like the movement away from a lot of these, oil production plants in the United States to try to get more quote unquote green energy. It seems like, that it's not exactly the smartest move with everything going on. I get that the United States in the end is probably going to be fine and we can be more self-sufficient. But it seems like it's the current party is making it a little bit more difficult for the United States to be more self-sufficient. One, do you subscribe to that theory? And two, what do you have to take or think about all of these, green energy policies and kind of the push towards that?
So we've written extensively on all of these topics, and just recently on Biden's decision to approve the Willow Project in Alaska, a piece I believe was titled "Between a Rock and a Cold Place." Biden is stuck in a vice of his own making. So on one side of that vice is the radical environmentalist Malthusian, you know, sector of his support base, these people who are fundamentally anti-human and anti-energy and anti-life. They believe nature needs to be preserved for nature's sake, regardless of the negative impacts on humans other than themselves, of course. But, you know, that's on one side of the vice. But Biden knows that's a small minority, but a very loud minority of his support base, and also a huge threat to the rest of his support base, who are sort of blue-collar workers, union, you know, financially disadvantaged, and so on. And he is an old school politician. We know him as the senator from DuPont because DuPont was the biggest company in Delaware, and Biden spent decades protecting the various interests of DuPont while he was in the Senate. And that's the lens through which we view his playing a footsie with these radical environmentalists. And so ultimately, when push comes to shove, Biden threw the environmentalists under the bus time and time again, just by releasing the strategic petroleum reserve last year to manage the price of oil. I mean, what did that do? It reduced the price of gasoline, which increased demand, which in the eyes of environmentalists increased CO2 emissions than would have otherwise been. And so, you know, the problem with the green energy transition is that it takes energy to transition, and that energy has to come from fossil fuels. And the price elasticity demand for fossil fuels is such that small shortages lead to huge prices, and small gluts lead to huge price decreases. And this is forever thus. And so we'll just keep repeating this until we either get new leadership or current leadership becomes more sensible to the actual physics of what's going on. But if you look closely, you can see Biden, when push comes to shove, ultimately will throw the environmentalist movement under the bus in favor of broader sort of lower energy prices for U.S. consumers. Even this Freeport LNG export terminal was really, wink, wink, not allowed to be turned back on until winter was over, and it was clear that we wouldn't need the excess natural gas. And so this is very plain and clear to see to those who know what they're looking for.
Yeah, and that makes sense because you know it does seem like I guess the narrative around the Democratic Party is that they're more for green energy, but it seems like you said that Biden has been kind of I guess pushing back against that narrative, so to speak, for his time in office, which in the end of the day it seems like it's almost necessary. So I don't really understand the transition or the full banning of electric or gasoline powered vehicles in like California and some of these other places. So I just don't really see that transition going, any smoother than it's, I guess, currently going, and kind of putting a hard stop on, all gasoline powered vehicles just doesn't make sense. I mean, we've seen electric vehicles have to get, gas powered chargers in order to charge their batteries. So it just, like I said, it just hasn't really resonated with me. And it seems like there's been a massive push, but there hasn't been too much action, I guess, taken towards that. But I want to transition a little bit here into the Fed and kind of the job they're doing. So I'll leave it open-ended for you, as Jerome Powell has kind of rapidly increased interest rates and then kind of slowed down a little bit the last two meetings by only raising by 25 basis points. But, we've seen some bank failures and other things like that. So, where do you kind of see this all going? And, I saw you had an article too called Don Jerome. So how do you feel that the job that, Jerome Powell is doing?
So we've written about the banking crisis from two separate lenses. One, the banking crisis is kind of cover for the things we wrote about in Don Jerome, which is basically the kneecapping of the crypto industry by choking them off at the fiat rails. And it's no coincidence in our view that among the first banks to fail were the two banks that did the most processing of dollars into and out of the crypto ecosystem, namely Silvergate and Signature Bank of New York, but also the venture capital bank, Silicon Valley Bank, that basically did business with all manner of VC firms that participated in a variety of crypto pump and dumps and dropping bags on retail shareholders. And so that those banks were basically wiped out in the early innings isn't a surprise to us, especially Signature, which was just sort of the analogy we used in Don Jerome was the classic baptism scene at the end of the first Godfather, where the new Don, Michael Corleone, makes very clear that the promises to keep the peace that his father made died with his father, and he takes care of all the family business in one go. They kind of took care of Signature Bank almost as an afterthought on a Sunday evening, which was truly remarkable. And it's all part of a broader push against the crypto industry, which is, of course, what we wrote about even this morning about the latest with Binance and so on. So that's one angle. The angle that's more concerning to us is the potential impact on regional banks. And we wrote a piece called Regional Fallout. We live in flyover country in the U.S., and we do all our banking at a regional bank or small community bank, actually. And that relationship between banker and business owner is critical to the functioning of the U.S. economy. And if Jerome Powell and Secretary Janet Yellen and President Biden and his team screw this up, they run significant risk of putting sand in the gears of the U.S. economy. If all we have left are the too big to fail banks, those banks don't know how to lend to small businesses, don't care to actually, don't need to make money. They make money by being too big to fail. And so, we described a personal anecdote in the piece before we were just before we were ready to launch Doomberg. We invited the person who runs private banking at our bank, our credit union in this case, and she got in her car and drove across town and sat in our office and listened to our business plan and gave us lots of pointers and knew what to expect from a timing and magnitude of the cash flows once we turned on paid for Doomberg, and thereby satisfying her know your customer anti-money laundering obligations directly in person. We know her very well. We do basically all of our banking with her. And if that relationship, that human-to-human touch point goes away, how are small business owners going to get the financing they need, the working capital they need, the banking they need to keep small economies, the small business part of our economy, which is a huge driver of jobs and growth, going? We would never get that service from J.P. Morgan, and nor would J.P. Morgan care to do it, as I said. And so the big concern here is the speed with which interest rates have risen is causing sort of mark-to-market losses at these small banks. And then the collapse of Silicon Valley Bank and Janet Yellen's pathetic performance in front of Congress when asked by James Lankford about whether all deposits in the U.S. at small banks would be safe. That risks catalyzing a run on small banks that would be very devastating to the economy. So those are the two angles, Brandon. We talk about the crypto angle and we talk about regional banks because those are near and dear to our hearts. So.
Yeah, and I mean, I agree with you 100%. I mean, over 46% of all United States jobs are through small business. So, I mean, small business is a huge, integral part of the American dream, owning your own business, other things like that. But I want to play a little devil's advocate with you here, just to kind of toss it out there because it seems like Silicon Valley Bank, was funding a lot of these, whether you want to call them like crypto casinos or whatever you want to call them. A lot of these companies that maybe, weren't I guess the greatest ideas in a sense, where they were really volatile business. Maybe there were more like techie kind of companies where they were kind of putting off making a lot of money, for a longer term. And then, at the end of the day, these companies had to go back to either venture capital or other things to try to raise. And unfortunately, because interest rates are tighter, venture capital was then tighter and kind of closer to the vest with lending and giving money in that sense as well. So do you think like in the short term, I guess that it might be, a little bit better just because like it'll avoid maybe some of these like outrageous tech companies that are coming in with crazy ideas and crazy evaluations, but then get, a bunch of marketing dollars behind them and are able to kind of, run somewhat of like a pump and dump like we've seen with like FTX and some of these others?
So there's a lot of lots to unpack there. So first of all, the mania in private market valuations that occurred in the post-COVID lockdown world was truly spectacular. We participated in it. We do a lot of private investing. We observed it. We passed on a lot of deals that were wildly overpriced. So there is some uniqueness to the Silicon Valley Bank failure. They had highly concentrated deposit base that was particularly susceptible to a run. Peter Thiel and Y Combinator and a few high-profile Twitter accounts played, I think, a disgraceful role in catalyzing the downfall of the bank that's at the beating heart of their own ecosystem. Talk about, sawing off the trunk of a tree to save a branch. But nonetheless, it happened. And the real risk isn't any sort of specific fallout from that failure. It's the risk of contagion. So if depositors at small banks believe that their funds aren't safe, they will move them. And they will especially move them when you look at the disparity in rates between money market or Treasury Direct accounts and what banks are paying depositors to keep their money in the bank. And so that's the real danger. The collapse in the valuation of unicorn startups, it was always going to happen. And that's part of the cycle of venture capital. When you're in a mania, the only thing that matters is deal access and deal flow. And now the only thing that matters is cash flow. And so you will see a series of really good startups be forced to raise at distressed levels, and those will be remarkable investment opportunities. And if you have powder dry, then they will get funded, and we're seeing that in our own private deal flow. You could buy great businesses at a much better price, and as Warren Buffett would say, what more does a long-term investor want than that? And so I would separate the two, but for sure, this highly concentrated deposit base at Silicon Valley certainly, combined with their mismanagement of the duration of their bond portfolio, led to a potentially unique situation. Our main fear is Janet Yellen's fumbling of it could reduce confidence from the system, and banking is nothing if not a game of confidence.
Yeah, for sure, and I agree though that the downfall of regional banks could be very detrimental. Just like you said, losing that personal relationship can really hurt like some small local economies, whether it's a restaurant owner or some just kind of general business that makes a city or a town unique. So I'm definitely worried about that in a sense as well. But on the flip side, the reason why Jerome Powell is, essentially raising rates is to kind of combat inflation. And but through that, it's strengthening the dollar compared to other fiat currencies. So I want to kind of dive into that aspect because it seems like Jerome Powell has, obviously raised interest rates at a historic pace, and they're slowing down a little bit, but inflation is still at 6% based on the last CPI print. Who knows where it will be, but I'm sure it'll still be above the, that 2% quote unquote goal that the Fed has every year. But in that note, and on that vein, I guess what can Jerome Powell, or how do you see this playing out? Essentially, do you think because there's somewhat of maybe a unique scenario in Silicon Valley Bank where it was too over leveraged and didn't allocate properly to its bond portfolio, but it showed some cracks in the banking system? Do you think because of that, maybe Jerome Powell might change his role and maybe pivot, I guess, quicker than he's been explaining, throughout throughout every single meeting? Or do you think, he's going to keep kind of holding true and, keeping his foot down when it comes to raising interest rates and trying to combat inflation?
Yeah, great question. I have a slightly potentially different answer than you may be expecting, one that we derive from our friend Mike Green, who was a guest on one of our Doomberg Pro webinars. Here we have a Pro tier where once a month we either bring on a great guest or we do a fixed presentation ourselves for our Pro tier subscribers. And he made an interesting call several months ago on a Doom Zoom, as we call it, where he said that paradoxically, Jerome Powell's raising of interest rates wouldn't really kill inflation in the manner that historically one might expect. And his rationale, which is one that resonates with us, is back to the lens of energy. High interest rates means less capital for energy exploration and development, which means less BTUs produced, which means higher energy prices, which means higher inflation. And so counterintuitively, there's no question that raising interest rates will flatten the economy. Look, if deposits leave small banks stop lending. If small banks stop lending, the economy stops working. That's what we're seeing right now. And so you will end up with a stagflationary scenario, which is something that we've been calling for the better part of a year. Once the price of coal exceeded the price of oil on an energy content basis last year, which was a unique, historical anomaly that we could find no precedent for. What that told us was the world was in desperate search for BTUs and didn't need the finished goods that you could get from oil, like all of the downstream chemicals and materials and so on. And so in that respect, perhaps in trying to fight inflation using the tools of yesteryear, Jerome Powell might be exacerbating it. And so we shall see. It's hard for us to imagine a scenario where inflation fully abates, and yet we have sort of echoes of an ongoing energy shortage, either real or contrived by our geopolitical adversaries like OPEC. Ultimately, we have been advocating since the Russia invasion of Ukraine that the proper response was not to try to sanction Russia's volume, but to flood the world with energy, crash prices, destroy his revenue base, and crush inflation all in one go. Nobody listened to us, of course, and why would they? We're a green chicken, and they're the president and his team. But in our view, if the quickest way to kill inflation is to have a glut of energy, and we're on the opposite path to that today, and that this is why we're seeing PPIs in the double digits, 20, 30, 40% in Europe, because they, committed suicide on energy policy, and this is what happens. And so that transfer function of higher interest rates into less production. Keep a close eye on the production in the U.S. shale patch. This is something that Gehring and Rosenzweig have been writing about for a very long time, and we believe that they will ultimately be shown to be correct. That's what we're looking at as far as like the direct policy implications of Powell's inflation hikes, interest rate hikes. Sorry.
Yeah, and I mean that's actually an interesting point in perspective, because I've always over Twitter, everybody kind of shouts from the moon that the 60% of monetary supply, the M2 money supply, has been dumped into the system since 2020, and that's the obvious reason for inflation. But in reality, I think it's shutting down the global economy because of COVID, and not really, I guess, producing that way. And in a sense, that's all kind of tied to energy, right? I mean,
yeah,
if energy is more expensive, driving, food from the farm to the grocery store is going to be more expensive just in turn, because everybody's got to make those margins. So it does make a lot of sense, the stagflation argument. But, I guess, what does that economy kind of look like? Because I guess stagflation, in a sense, to me, seems like it's not going to be, very much growth or anything like that. And we're just going to kind of stay where we're at. Is that kind of, I guess, the theory that you subscribe to? Or do you think, due to stagflation and really no growth, that, maybe the economy will take a turn for the worse, and it'll be, a recession, or, maybe a not quite a soft landing?
So the definition of stagflation is slow, no, or shrinking growth combined with high inflation. And that equation means reduced standard of living. That there's just no circumventing that. And in fact, as we have argued relentlessly since the beginning of Doomberg, energy is life, and your standard of living is literally the amount of energy you are allowed to waste personally, because disorder is spontaneous. And in order to impose order on your local environment, you have to waste heat. And so if we have an energy shortage, that has to manifest itself in lower standard of living. And in this case, you can dress it up in economics terms like stagflation, but ultimately that's just the transfer function or the transmission mechanism of a poor energy policy into reduced standard of living. And the longer this goes on, the more we run the risk of political upheaval. And population is, they tend not to like it when their standards of living shrink. And we're seeing the rise of populism in Europe, Italy, a lot more populism in Germany than is making it to the press. The UK, we're seeing the riots in Paris and across France. This is all just symptoms of the greater disease of a lack of serious thought about energy. And just to put some numbers around it again, just before COVID hit, the U.S. was producing 13 million barrels a day of oil and change. And now 3 years later, God, it's been 3 years. 3 years later, we're producing just over 12 million barrels a day. And then for the past year, or past 8 to 9 months, we were releasing 1 million barrels a day from the Strategic Petroleum Reserve, closing that wedge. Well, if we don't have much more to release from the reserves, and production stays flat at 12 million barrels a day or begins to roll over, and OPEC stays true to their commitments to cut production on a go-forward basis, it's not out of the question that we could see $90, $100, $110, $120 oil again. And in that scenario, with banks under crisis and no longer lending because of elevated interest rates, you could see stagflation, which basically is, again, a shrinking economy and rising prices. And that would be a disaster for Biden and the Democrats heading into 2024 for sure.
Yeah, and I mean, this makes sense, but for me, I see that, kind of heading into 2024, that there might be some more political pressure from Powell to essentially just like pull back the reins and essentially reverse course at almost the same historic pace that he, raised interest rates, simply because of, like you said, that 4-year cycle, the political pressure that might be under wraps. Um,
So if we do that without loosening the regulatory reins over the oil and gas industry in the United States, then look out, because you're going to see massive inflation without concurrent new drilling and exploration or investment by the big oil companies. At the same time that we're talking about all of these impacts of interest rate hikes and so on, you have California, which is something we're going to write about, hopefully, with this insane new cap on refinery profits. And I saw Elizabeth Warren was raging against price gouging by egg makers, who are basically price takers selling the ultimate commodity. And yes, the price of eggs has skyrocketed again because of a variety of policy and sort of errors in that regard, and a few natural issues as well, like disease and so on. But the price of eggs is up threefold since the pre-COVID days, and so if we realize that we've gone too far, crush the banks, lending has stopped, and the economy is contracting, and Powell pivots, but we still have the environmentalists, suing every oil project development and appealing all the way to the Supreme Court at every opportunity, and suing again on a new basis, and we don't actually increase our energy supplies. Well, then if we pivot, if we don't have any energy, look out stagflation again. So the real issue is again is how do we set up a framework of policies that support the production of excess energy, which by definition is excess standard of living, and then how do we equitably share that across the population? And what we're seeing right now is rising income inequality, social unrest, lack of energy production, and rising interest rates, which is doing nothing to help the energy situation.
Yeah, and so I mean, it does seem like very doom and gloom going forward, especially just based on these policies, and it seems like they're all very reactionary. But you did generally speaking, in a high inflationary environment, people try to go to various quote unquote hard assets, whether that's kind of real estate or gold, which is what I kind of want to dive into next, because you had a piece called gold in handcuffs, and in this piece, you kind of compared, Bitcoin to gold in a sense, and we've seen, Bitcoin kind of, float around and get up a little bit to, I haven't checked the price in the past couple of days, but 28,000 ish range from the lows of 17. But gold has been, I guess, relatively, it seems like stagnant for the year's time, especially, during massive inflationary environments. And it seems like, a lot of the gold bugs been yelling from the clouds that in inflation gold will kind of raise and get more valuable in a sense, and it doesn't seem to have been the case for the past couple of years. So how do you view gold these days, and where do you kind of see all that market going?
So as we're talking, gold has gone on a $40 an ounce run in the past, I don't know, hour and a half, and it's trading at $20 $2,020 per ounce right now. I would say gold is an interesting one, like we are gold bugs, and the piece we wrote, Gold in Handcuffs, was a bit of a cautionary one, which we can get into if you'd like. But to your specific question, if you price gold in Japanese yen, or you price gold in Turkish lira, or you price gold in, various currencies that have gone under sort of hyperinflationary type periods in the past several years, you'd be very glad that you own gold in those economies. And from their perspective, gold is doing what it was meant to do. And even here in the US, I mean, gold relative to other assets has performed quite well. We don't view gold as an investment. We view gold as part of our saving strategy. We make money in fiat because we live in a fiat world. We save money by buying hard assets, as you described, like land and collectibles and gold. And then we invest privately where we can affect the outcome. That's sort of our financial strategy here at the Chicken Coop. But I would say, gold has had a pretty impressive run here in 2023. And if people are waiting for a sort of a dramatic collapse where they'll be able to cash in all of their riches because they were smart and owned a lot of gold, like I don't think that's how it's going to play out. But I'm just pulling up the chart as we're talking. If we look at the year-to-date chart for gold, it is pretty impressive run. Yeah, it started the year at just over 1,800. It's 2,000 now. That's what 12% year-to-date. It's just doing a quick guess. I mean, that's not a bad run considering how the markets have done. So.
Yeah, and I mean, it seems like like you said, as you described it, it started kind of at the beginning of this year, but we've also seen kind of some wonkiness in the markets when it's come to the beginning of the year. I mean, I know January we saw Tesla up like 90%, and we saw like a lot of, I guess, runs in various companies, kind of more risky, quote unquote, risk on assets and other things like that. But yeah, like you described, it seems like gold has kind of been steady and doing pretty well this year, especially to start it through Q1 here. But you mentioned something about kind of like almost like essentially like the Powell and the Fed have been weaponizing the dollar, but people are kind of I guess flooding to gold. It seems maybe not to get rich, but using it as like savings technology, as you did kind of describe. So do you see that market kind of, I guess, developing back to what I guess it was previously quote unquote known for, like more as like savings technology and kind of more of that hard asset, where it's going to be, I guess, more of a popularized investment or savings technology, however you want to describe it, than it's kind of been in these past couple of years, as like people have just almost like seemingly FOMO'd into whatever was the next hot name, whether it was like AMC or GameStop or something like that.
So I would view the YOLOing into sort of what we call greater fool's trades more of a socioeconomic genesis to that phenomenon than a pure economic one. There was a lot of boredom in the lockdown era. There was also a lot of cash being sent directly to consumers, which is, of course, the cause of the burst of inflation that we've seen, as along with the energy crisis. And I think that in the middle of a mania, people who are drawn to assets like gold almost never participate in such manias, right? And so then they feel like their asset isn't performing, and it takes a crisis for your asset to perform on a relative basis. And here we are at the potential beginnings of a crisis, and gold is outperforming. And so, we have a general rule, which is that we cannot invest in something that we believe to be a greater fool's trade. Like, we limit our private investments to businesses that produce dependable cash flows and, in the worst case scenario, pay a good dividend. We just could never buy AMC because we think a bunch of other suckers are going to buy AMC and buy it back from us at a higher price. That's what casinos are for. And if I was going to go to casino, I would learn poker, because at least that's a game of skill, and I would have a fighting chance at earning some extra cash as opposed to just giving the house my rake every day. So, but there's a whole army of people for whom Matt Levine has a great series of columns in this regard, for whom this is a form of entertainment and gamification. In fact, Robinhood's app, the entire basis of its popularity is that it embeds gamification into what had traditionally been the serious business of buying and selling securities. And when money becomes a game, there's another sort of lens here, which is to many people, the growing income inequality forces them to make larger and larger risky bets, because the whole phrase YOLO is you only lose once. What's your alternative? Hey, if I get lucky and I catch tiger by the tail, and I can convert $20,000 into $800,000 and then quit my job and retire the FIRE lifestyle, then why not? It's a swing at the fences. It's indistinguishable from a lottery ticket, really, when you think about it. But again, where we are and the savings we have and the sort of business we're building and so on, it's just not prudent for us to participate in such manias. We also avoided many of the manias in the private market as well, although it's very difficult to do. You see these startups where you actually know the founders and you don't have a super high regard for them, and you pass on the deal, and then 2 months later you read in Crunchbase that they raised money at $1 billion valuation, and you're thinking to yourself, like, there's no way that money isn't going to be torched. So it is what it is. To the question of gold, You don't put money in gold hoping to get a 20x return on your money, because if you get a 20x return on your money, you got bigger problems in society to deal with than what to do with all of your excess relative wealth.
Yeah, and that makes all the sense in the world. It's more of like a safe haven. But I just thought it was interesting that you kind of compared Bitcoin to gold. I mean, that's kind of like the narrative, right? It's Bitcoin is essentially like digital gold, right? And but usually. Just in general speaking, you see the number go up on Bitcoin is like tenfold at the very minimum compared to what you see from gold. But like you said, I guess gold bugs in a sense are not really looking for that volatility. They're not really looking for that. They're looking for more of, I guess, savings technology in a sense, opposed to, the number go up in fiat terms. But
well, here's how I view gold. If I have 20 gold eagles in my safe today, that's $40,000 roughly. 20 gold eagles today can buy you a decently trimmed mid-size SUV. In 15 years, if I hand 20 American Eagles to one of my children, they will be able to go out and buy a well-trimmed mid-size SUV in 15 years. That's my view of what gold's role is. In the piece, we say that the overlap in the Venn diagram of the reasons why people own Bitcoin and the reasons why people own gold are pretty comprehensive. It doesn't mean they serve the same function. But both sides would like some of their value outside of the system. Both sides view their chosen vehicle to express that view as having a certain moneyness about it. In some ways, Bitcoin is more interesting because it has the possibility to be a more effective medium of exchange than gold. On the flip side, it is at least impacted by all of the crypto fraud, and the price swings and the volatility of Bitcoin far exceed that of gold, which makes it less attractive from that perspective. But in the piece, Gold and Handcuffs, we did say, by the way, like this thing that many gold bugs are wishing for, which is that the BRICS develop an alternative to the U.S. gold, the U.S. dollar that involves gold as a key part of the settlement of international trade, runs the risk of gold ownership being banned in the U.S. It's happened before. The same tactics of Operation Choke Point 2.0 that the government is directing towards the crypto universe could very easily be redirected to the gold universe. And that piece, which did quite well for us actually, and triggered an awful lot of comments and emails and discussions amongst our subscribers, was a real, I think, wake up call for people that, hey, wait a minute, these precedents that are being set against the crypto crowd. Hey, I'm a no coiner, so it doesn't matter to me. Yeah, it does matter to you, because those precedents become the gun that points towards you in the future. And if Vladimir Putin and President Xi and MBS get together and suddenly the price of gold spikes to 4,000 or 5,000 or 6,000 an ounce, you can bet your bottom dollar, pun intended, that the U.S. government is going to take action against gold owners.
Yeah, that's fair, 100%. And I kind of want to dive into your last piece that you mentioned at the beginning of the show that you dropped today about price discoveries, because it gets into a lot of the crypto fraud that we've seen here. In the past couple of days, or not couple days, couple months or so. We've seen the FTX with Sam Bankman-Fried, but the real winner in all of this has been CZ of Binance. And there's been a lot of it seems like rumblings, a lot of regulatory kind of crackdown, and a lot of things kind of happening to Binance, but for some reason they're still chucking on. I mean, I'm under the theory that I think that eventually that they're going to probably fail in some point in time. I'm not sure when that is, but they've become essentially the biggest player in the game. Majority of Bitcoin trading is on their platform and other things like that. So, I guess, how do you view that? And why don't you get into your piece about price discoveries?
Yeah, so price discoveries is a great title. We start all our pieces with trying to figure out what a great title would be, and the main point in the piece, which we've been making for a very long time, is Bitcoin should not be priced in US dollars. People should not view the quote of Bitcoin on their screen trading right now at 28,191 or 192 as we're talking. That is not US dollars. That should be viewed as tethers. Bitcoin trades in tethers. And tethers, if they're backed 1-to-1 for US dollars, and you could easily exchange your Bitcoin for tethers for US dollars, then okay, maybe you could quote the price of Bitcoin in tether, but in dollars. But you shouldn't today. And one of the reasons why we think you shouldn't is because we believe that Binance and FTX and other exchanges had the ability to effectively collaborate with Tether and print these tokens out of whole cloth and then move the price of Bitcoin around to anywhere they want. And they do. And the genesis of the piece, the reason why we wrote it was this explosive 74-page complaint, civil complaint against CZ and Binance that dropped last week from the Commodity Futures Trade Commission, which had previously kind of been viewed as sort of an ally to the crypto world, and then they dropped the hammer on CZ and Binance. And when you read that charging document, it reads like a criminal indictment, and we would be shocked if charges don't swiftly follow and Binance doesn't collapse. But in that document, it's very clear the U.S. government has insiders collaborating, access to a massive treasure trove of information. They know exactly what's going on in Binance, and they're prepared to do something about it. But in that document, the two things that jumped out at us is Binance routinely trades options denominated and settled in Tether for digital assets like Bitcoin and trades against its clients, knowing full well what their clients' order book looks like. But also, perhaps more damningly, they have several hundred in-house prop desk accounts, presumably with unlimited access to Tether, so they could take the opposite of any trade they want without having to worry about margin calls and so on. And they just essentially are running a pilfering operation against their client base. Why anybody listening would have any assets whatsoever on anything related to Binance after knowing all this and reading that document, ultimately it's on you at this point. We suspect that Binance won't be long for this world, and that someday we'll be reading that CZ has been arrested, because it's very clear that that's the intent of this document. Now, whether he committed a crime or not, and all these are just allegations, and he, especially if it's a U.S. charge, has the right to presumption of innocence. But boy, does that document ever read like all of the things we've been writing about for the past 2 years, and all of the heat that we've taken from the crypto world and some of the Bitcoin maxis. As we said in the piece, we won't be holding our breath for an apology, but the things we've been writing about for the past 2 years sure do seem to be coming to pass here.
Yeah, and I mean, when it came out, like the FTX kind of scandal, it came out that SBF had some group message with some of the other big names of the exchanges called market makers and things like that. So, I mean, in the end, it doesn't seem like it's super surprising. And, part of I guess the Bitcoin maxis rally call is to get Bitcoin off of exchanges because of,
Right.
things like this, right? Because, essentially they're, just trading against their own clientele and other things like that too. So, yeah, I mean, it definitely seems like there's some sketchiness going around with CZ, but me personally, I'm kind of surprised that he's made it this far, as we've seen, multiple other exchanges kind of, I guess, fall through the wayside, go bankrupt, what have you. So, I guess in a sense, why do you think that he's been able to, I guess, make it this far? It does seem like his time is slowly running out, but what has kind of allowed CZ to, I guess, keep running and operating in business, although we've seen FTX, Celsius, BlockFi, some of these other ones kind of fall by the wayside.
So it's a great question, and we have a friend who is a famous short seller, Mark Cahotis. I'm sure that's a name that you may be familiar with. And Mark has a theory about these crypto exchanges, that they are essentially money laundering operations, and that they arose in the aftermath of the collapse of Wirecard, which is this famous German fraud that was essentially a money laundering operation operating in plain sight in the DAX 30. And the volume of trades on these offshore exchanges really only began to explode as Wirecard collapsed. And ultimately, there is a market for money laundering. Like the size of the global criminal market is huge. It's measured in hundreds of billions of dollars, and that money needs to go somewhere. And when FTX collapsed, it all seems to have gone to Binance. And so it'd be fascinating to see where that money laundering goes after Binance inevitably collapses. Time will tell. But Cahotis's view, which was an interesting one, is that this is basically, FTX is not a fraud. It is a money laundering operation wrapped in a crypto fraud, with a crypto wrapper, as you would say. And it's a pretty interesting way to look at it in our view.
Yeah, I agree. It'll be interesting to see how this full case kind of all plays out as well. I'm sure a lot of people on the internet will be following that very closely. But you've been very generous with your time this morning, so I want to give you the opportunity. Why don't you tell people where they can find you and what you all have going on?
Yeah, Brandon, really appreciate it. The primary place you can find us is at doomberg.substack.com. As I said, that is where we publish 6 to 8 times a week. You can also follow us on Twitter at DoombergT, although we are sort of de-emphasizing Twitter as it becomes ever more toxic. And if you subscribe for free, you will get the first sort of third of all of our pieces, and maybe one of them will eventually entice you to jump over the wall and jump to paid. Our paid subscribers get all pieces, and also they get to comment. That we have a very vibrant comment section, which we close to only paid subscribers, which means if you want to troll us, you have to pay us for the privilege. But really fun, really great work of our life, and really fascinating to research these pieces. We learn an enormous amount. We have such a great network of experts who help us as we research these pieces. And so it truly is a wonderful way to live. We've built a great business out of it and couldn't be more blessed. We wake up every day counting our lucky stars that we were able to create this franchise on a full cloth in 2 years. And we intend to savor the success and to continue to earn the business of our precious subscribers. So thanks for the opportunity, and best of luck to you as well, Brandon.
Yeah, thanks so much. Yeah, everybody go check out Doomberg Substack. It's one of the best in the biz. Obviously, the number one financial Substack. And yeah, I mean, great Twitter follow as well. So follow him on Twitter. I'll have all that in the show notes. And yeah, Doomberg, thanks so much for coming on, man.
Thanks, man. Have a great rest of your day.
Thanks, you too.